Good afternoon, everyone, and welcome to this deep dive session on the proposed amendments to the Tier 3 and 4 public sector reporting standards. I'm Jamie Cattell, and I'm a project manager at the External Reporting Board in the Accounting Standards team. And I'm joined today by Carly Berry, who is also a project manager in the Accounting Standards team. You'll be hearing from both of us intermittently throughout the presentation today. We will also take some time at the end to answer any questions you have, so please feel free to submit any questions using the Q&A function that you should find at the bottom of your screen. And we also have Anthony Heffernan, Director of Accounting Standards, looking at the chat, and he can answer any other questions that you want to post through there. First, a quick introduction to us and who we are. We are the External Reporting Board. As you can see up there, our vision is that New Zealand prospers through effective decision-making for resource allocation informed by high-quality, credible, integrated reporting. But in a more practical sense, we are an independent Crown entity, and we are responsible for developing and implementing accounting, audit and assurance, and climate reporting standards in New Zealand. What we're here to talk about within that grouping today, though, is two accounting standards, which are developed for the public sector and are part of the accounting standards framework, which you will see put up on this slide. So reporting by public sector entities in New Zealand, as many of you will probably already know, is split into 4 tiers. And within each of those tiers, there is a set of size criteria. Tier 1 and 2 are the larger tiers, and those are full PBE standards, which are based on international public sector accounting standards issued by the International Public Sector Accounting Standards Board. Whereas the Tier 3 and 4 standards are New Zealand specific, that is, they were written from scratch by the XRB specifically for smaller public sector entities. A public sector entity with total expenses of less than $2 million per year is able to apply the Tier 3 standard, while one with total operating payments of less than $140,000 per year is able to apply the Tier 4 standard. The other criteria you'll see on that slide is that an entity cannot have public accountability. While all public sector entities are accountable to the public, in this context, public accountability has a specific meaning, and that means that the entity has debt or equity instruments traded on a public market, for example, the New Zealand Stock Exchange, or it is deemed to have higher public accountability under the Financial Markets Conduct Act 2013. The number of entities in this grouping is quite small, and if you're caught as an entity, you're usually aware of it. So for most entities, the primary criteria is their size. You might be wondering why it is that the Tier 3 and Tier 4 standards were needed at all. Obviously, we've got this huge range of entities with different levels of complexity and different activities that they conduct. So part of the challenge really for us as standard setters is balancing the user and the preparer perspective. And by that, we mean the objective of financial reporting from a user perspective is to provide decision useful information. However, whenever a piece of information is being prepared, that involves a cost, and we need to ensure that the cost of preparing that information doesn't exceed the benefit of that information to the users. And part of how we strike that balance is by having these 4 tiers, which allow us to develop less onerous reporting requirements for the smaller entities. In the context of Tier 3 and 4, this meant making the standards as simple as possible to apply for preparers while ensuring that they still continue to provide meaningful information that promotes public trust and confidence in public sector entities. So what actually are the Tier 3 and Tier 4 standards? These standards have been applied by public sector entities since 2015, bearing in mind that it would be entities at the smaller end of that scale, that 2 million to 140,000, and under 140,000. The XRB took a slightly different approach to developing the Tier 3 and 4 standards than it usually would take for Tier 1 and Tier 2. And it's different in that rather than having a full suite of standards, Tier 3 and Tier 4 each consist of only a single standard for the tier. The Tier 3 standard is one that is accrual-based, while the Tier 4 standard is one that is cash-based. In order to make them simple to apply as the single standards, they were written with an attempt to use less technical language wherever possible, and a particular focus was on minimizing the use of accounting terms. They also focus on making the actual requirements simple to apply by reducing the amount of judgment you need or the need to make any other significant estimates. And they're also only intended to focus on the most common transactions for smaller entities, rather than attempting to provide guidance on everything that they could possibly enter into. And because these standards were brand new, they were supported with additional guidance material and optional templates. That brings us to really the changes that we're talking about today and why we've decided or come to the conclusion that these need to be made or should be. After the standards had been applied for 5 or so years, it was timely really for us to check in on how they were working in practice and ensuring that these standards for small entities were achieving their objectives. As part of doing that, we began the post-implementation review in September 2020. And through that process, we got over 100 submissions. The good news for us was that these submissions told us the standards were working well overall. Nobody told us the standards totally missed the mark and that Tier 3 and Tier 4 should just be thrown out entirely, but they're not perfect. Submissions also told us that there needed to be improvement in some areas. And among smaller entities, there was still some that were struggling to understand and apply the standards. We got feedback on a lot of specific parts of the standards, but there were some areas that were raised more frequently than others. The 6 areas that came up most frequently are listed on the right-hand side of the slide. I won't read down them all because we'll be going into them in detail. And for all of those, we're proposing changes, which we will now be going into. So starting off with our proposed improvements to the Tier 3 standard, I will be handing over to Carly to talk to us about service performance reporting.
Thank you, Jamie, and good afternoon, everyone. So the first section we'll look at is the service performance reporting section. We've heard that many preparers were finding these requirements difficult to understand and apply in practice. And in particular, they noted that the outcomes and outputs terminology was confusing. So we are proposing some amendments to the Tier 3 standard to align these requirements more closely with those in the Tier 2 PBE standards, more specifically PBE FRS 48. As part of this alignment, it means we are moving away from the outcomes and outputs terminology. So this slide gives you an overview of the proposals, and those familiar with PBE FRS 48 will notice the similar language used. So the proposals ask an entity to describe what it is aiming to achieve over the medium to long term, to describe the significant activities that it has undertaken during the financial year to advance its objectives, as well as its significant achievements in this period, and also to quantify, to the extent practicable, their significant activities and achievements. So the following slides dive into these proposals in a bit more detail. So for an entity to provide information on what it is aiming to achieve over the medium to long term, it considers first what its broader mission or purpose is. So the entity's mission or purpose is the difference that it is looking to make in the community, which would apply over the life of the entity. This information would either be disclosed in the entity information section of the performance report, or would be incorporated by cross-reference from the entity information section to another statement or report available to users at the same time. An example of a report like this would be an annual return to a regulator. The information required in the statement of service performance is linked to this broader mission or purpose, but more specific information will be required as the focus is on the entity's objectives in the medium to long term. So to give an example, a school's mission or purpose could be to provide quality education and support to the community. And in contrast, this medium to long-term goals or objectives would be to build some new school buildings to increase its capacity in a growing neighborhood. So when reporting on service performance information, a Tier 3 entity must select an appropriate mix and a meaningful mix of measures and or descriptions of activities and achievements that occurred in the financial year. So these measures could be quantitative. So for example, an entity could disclose a quantity of goods and services provided, or the time taken to provide goods and services. The measures could be qualitative. So for example, disclosing compliance or non-compliance with a quality standard, or providing ratings such as low, medium, or high. Qualitative descriptions are also permitted. So for example, descriptions based on participant observations. The proposals will include guidance on what makes a measure or description appropriate and meaningful. The entity's users and what they need to know should be kept top of mind here. The guidance links to qualitative characteristics that information should have to make it useful to users, which you'll see on the right-hand side of the slide. So information should be relevant and faithfully represented, understandable, verifiable, as well as timely and comparable. This information is already in the Tier 3 standard, but we are emphasizing it in this section here. The standard also emphasizes that an entity does not need to report everything it has done in the financial year, only its significant activities and achievements. So again, the needs of the users must be considered here. So consider, would a disclosure of an activity or achievement influence users' understanding of the entity's service performance? And if the answer is yes, then it is likely to be significant to include in the statement of service performance. The standard also does not prescribe how an entity should present its service performance information. So graphs, tables, or images can all be used, whatever makes the information most clear to users. And finally, we come to a new principle that we are including in the Tier 3 standard, and that is that service performance information should be reported consistently from year to year. When there are changes to what is reported or how it is reported, an entity must explain the nature of the changes, explain the effect of the changes on the current period, and also disclose reasons for the changes. So some examples of changes could include changes in the nature of the entity's activities from the prior year or from what was planned. It could also be changes in descriptions of goods and services or the way that they're aggregated, or changes in the measures and descriptions used. Tier 3 entities are not required to make changes to comparative information, but they can do so if they would like. However, they would need to disclose the effect of changes on this comparative information. So before we go on to the next section, I have a poll that I'd like to share. Just bear with me for 1 minute. Oh, Jamie, would you be able to bring up the polls? I can't seem to get access to them. Oh, okay, there we go, thanks. So this poll is to give an indication of how you're feeling about the proposals I've just discussed. So if you'll all just take a minute to vote, and this information will be really handy when we look at responses to our proposals over the next few months. Okay, so mostly positive, which is good. I see there are some unsure responses there, and of course I have gone into a lot of detail. We are proposing quite a few changes to the section, so I understand if people need a bit more time to digest before they can be sure, but looks like it's heading in the right direction. It's good. I'll now move on to revenue recognition. So the next area of our proposed improvements is to the revenue recognition requirements. So during the post-implementation review, we received feedback that the user return revenue recognition approach for grants and donations was too restrictive. And specifically, there were concerns that the approach does not allow a Tier 3 entity to recognize revenue over time as the funding is spent, nor does it always result in appropriate accounting outcomes in practice. Overall, Tier 3 entities want increased flexibility to defer revenue recognition. So in response, we are proposing to remove the use or return condition and introduce a new revenue recognition approach for grants, donations, and bequests. This approach allows for the deferral of revenue when there is one or more documented expectations from the resource provider over the use of the funds, and the expectation or expectations have not yet been fully satisfied. So the flowchart you see here sets out an overview of the process to follow. There are a few things to point out, starting from the top. So this revenue recognition approach only applies to grant, donation, and bequest funding. The new approach only applies to significant funding as well. This is to prevent entities having to spend time considering whether there are any expectations of insignificant funding, which would probably not be useful to users. The expectation should be documented and agreed between the entity and the resource provider, which we will discuss further on the next slide. The expectation should also be specific enough to allow the reporting entity to reliably demonstrate to the resource provider when the expectation has been satisfied. And again, we'll discuss this further next. And when all these criteria, or if all these criteria are met, when the funding is received, it is recognized as deferred revenue, which is a liability on the statement of financial position. And revenue will be recognized as or when the agreed expectation over use is satisfied. So our proposed amendments include guidance on how an entity can identify an expectation for the purposes of revenue recognition. There are two key criteria to meet. The first one is that the expectation must be documented and agreed between the parties. So here it is important to note that the expectation is one that the resource provider places on the use of the funds. An internal expectation, such as a management or board expectation, is not relevant here. And an expectation or agreement between the parties would typically be documented in writing, or we feel it was likely to be. However, other methods are acceptable as long as there is some sort of evidence to show. So, for example, a recorded Zoom call where the expectation is discussed and agreed is acceptable. The second criterion to meet is that an expectation must be specific enough to reliably demonstrate when it is satisfied. This is the case even when the resource provider does not intend to monitor use of the funding. Therefore, there's no requirement to show or prove that the resource provider can enforce compliance with this expectation. Rather, the intention of the requirement is to prevent a situation where there is a vague expectation, which makes it very uncertain as to when the revenue, or when or how the revenue will be recognized in the future. Expectations which are specific include expectations that the funding will be used to provide specific goods or services, or acquire or construct specific assets. An expectation with a specific time frame is permitted. So, for example, an expectation for an entity to use the funding to cover general operating costs over a 3-year period is specific enough to meet the requirements. However, an expectation for the entity to use the funding to cover general operating costs over an unspecified timeframe would not be specific enough. And this brings us to timing of revenue recognition. So revenue would be recognized as or when the expectation over use of the funding is satisfied. This could be at a point in time or over time, and there are 3 things to consider when determining this. First is the nature of the expectation. So for example, an expectation to purchase a vehicle is likely to result in a different pattern of revenue recognition as compared to an expectation to construct a building. Judgment is required to determine the pattern of revenue recognition, although we propose to include several examples to help users, as you can see on the slide to the right. And one final point to note is that there may be more than one expectation attached to the use of the funding. And in this case, each expectation should be accounted for separately. So here we will go into another polling question. So if you could just give us your thoughts, your initial thoughts on this new revenue recognition approach, that would be very helpful. All right, so that's very positive. Good to see that we are heading in the right direction here. I will now hand over to Jamie. Thank you very much.
Thanks, Carly. Yes, so I am going to be looking at the required categories into which you have to group your revenue and expenses in the Tier 3 standard. This was a very common area that people would comment on, and what we heard was that some preparers are finding it difficult to classify their revenue and expenses into the required categories. We also heard that having these difficulties was resulting in some preparers still presenting their statement of financial performance with full lists of revenue and expenses from their trial balance, rather than aggregating and presenting an overall view. In response to this, we're proposing to increase the number of required categories by splitting some of the existing categories apart based on both their nature and on the source of the underlying transactions. Our view is that having additional required categories will make it easier for entities to apply by allowing us to more clearly define what each of these categories are. We also considered that with these additional categories, there shouldn't really be much need to disaggregate further on the main statement of financial performance. So we're proposing to remove the option to provide that further disaggregation there. However, if an entity still wants to provide more information, then that they are able to do so in the notes. So that's not changing. Of course, this raises the question of what the new categories we're proposing actually are. The table on the slide above shows the proposed categories for revenue in the Tier 3 public sector standard. As you can see, the new categories we're introducing mainly come from disaggregating existing categories. Specifically, we're disaggregating the donations, fundraising, and other similar revenue into donations, cohab, bequests, and other fundraising activities. We're also coming up with capital grants, and we've got other grants from non-government organizations. I'm sure you all know what a capital grant is, but for clarity, we mean a grant which is given specifically to be used in purchasing or constructing a fixed asset. The funding from central or local government, we're proposing to split into general funding received from central or local government and into revenue from service delivery grants or contracts from the government or from non-government, depending on the source. We're also proposing to introduce a new category here, which is sale of goods or services for as a commercial activity. And this one is a more significant change. So I will be coming back to that one to talk about what we mean by that. But before I do, let's have a look at the expenses. So like the revenue categories, we're proposing to disaggregate the existing categories. The main ones that we're disaggregating are employee-related costs, which we're splitting into employee remuneration and volunteer, well, other employee costs, really. We're proposing to also disaggregate the costs related to providing goods and services into those that relate to the new commercial activities group and others that relate to the delivery of entity objectives. What do we mean by commercial activities? As this is a new concept to be putting into the Tier 3 standard, we're proposing to add a definition of commercial activities, which is activities conducted by the entity with an intention to derive a surplus and which do not in themselves contribute to the achievement of an entity's stated purposes. Really, you could also think of it as like an unrelated business type activity. For example, you could be an entity that provides low cost or free mental health services as its main activity, but which also sells apparel to generate additional funding to provide services. Even though that funding might be used by the entity to achieve its objective, the selling of the apparel doesn't directly achieve the entity's objectives on its own. However, we don't think that all activities should be separated and grouped as commercial activities just because they're unrelated to the main activity. So whether or not something represents a commercial activity of this kind is going to involve a little bit of judgment. And we have a couple of criteria that you can think about when looking at that. First is the primary purpose of the activity. Is it primarily to derive a surplus, or does it have another purpose which deriving a surplus is secondary to? For example, an activity may derive a surplus, but primarily be an opportunity to promote awareness of the entity and what it does. The other key consideration is the entity's intentions for the activity. Does the activity represent a sincere intention by the entity to conduct a commercial activity or run a business? And you can sort of get a feeling for this or proxies for it by looking at things like the scale. Is it conducted at such a scale and with sufficient formalized structure to imply that there's an intention to operate a commercial activity? Or is the activity really a small ad hoc activity that the entity does without formalizing how it's done to any great degree? The former starts to look a lot more like a business or a commercial activity than the latter. Another example could be the frequency of the activity. Does the entity do it on a regular schedule or an ongoing basis, or is it very intermittent and irregular? It's easiest to illustrate all of that really with the examples that we have on the right of the slide. Consider an entity with a dedicated site that regularly produces and sells baked goods versus an entity that occasionally has a cake stand at the local fair. While both of these involve selling goods to derive a surplus, the former gives a much greater impression that the entity intends to operate a commercial activity than the latter. That raises the other question, though, of how to treat it. If it's not commercial, then what is it? This kind of activity, if it's not commercial, really is a fundraising activity more so than commercial. The other one that you'll see that we required a split there is, rather than general funding, was the funding from service delivery grants or contracts. These are grants that are received from government or other entities that are in substance a contract for the delivery of goods or services. And whether a grant meets this definition will again involve some judgment. And listed on the slide are a couple of factors that you can look at. First is how closely related the funding is to the specific services provided. Think of a lump sum grant generally intended to fund counselling services versus a grant received for a specified number of service hours where the total grant is calculated based on that total number of hours. The latter is a lot more closely related to the provision of specific services than the former. Another factor could also be the timing of the payments. If funding is only determined and receivable by the entity after it's provided a good or service, it is more likely the funding is a service delivery grant or a contract. For example, an entity might have an agreement where it receives from a funder $10 for every school lunch it provides within a specific time frame. As noted as well, we're also proposing that an entity will split the funding from these kinds of agreements based on their source, so between government and non-government sources where that's applicable. And I believe this brings us to our next polling question about the suitability of these categories. So please tell us whether you think we've landed somewhere reasonable here or if we've missed the mark. Okay, so a little bit more uncertainty here. More than half think that we're on the right track. Those of you that are unsure, please feel free to either let us know in the chat here why you think that you're uncertain about whether these are the right categories or whether they'd be helpful, or preferably, please consider making a submission on the review or the proposed changes. That brings me to the next big change, which is the alternative measurement options for assets. This was another very frequently commented on area. Many respondents told us that the Tier 3 standard should include simple requirements for revaluing assets, rather than requiring an entity to opt up to the Tier 2 standard in order to revalue assets. We are adding the option, or proposing to add the option, to revalue assets to the Tier 3 standard, but with some limitations. In order to keep the standard simple, we're only adding it where revaluing an asset doesn't require significant judgment or estimation. So we're adding that option for property, plant, and equipment, for investment property, and for publicly traded financial investments such as shares and bonds. This list is actually also consistent with the types of assets that respondents told us they wanted to revalue primarily anyway. We are, however, introducing some other simplifications to make it easier. We are retaining the option to use rateable value for land and buildings instead of requiring fair value. So for these asset types, we're proposing that you'll have a choice between using rateable value or a valuation by an independent valuer. For investment property, we're proposing that these assets will be treated in the same way as property, plant, and equipment. We're also proposing that all property, plant, and equipment and investment property revaluation movements will be recognized directly through a reserve within equity or accumulated funds, rather than go to the effort or introduce the complexity of something like other comprehensive income to the Tier 3 standard. For the financial investment revaluation movements, we're proposing that these will be recognized as revenue or expense within the statement of financial performance, so not through an equity reserve. What does this look like for property, plant, and equipment? As I mentioned, we're proposing that PP&E will be able to be valued based on a current value determined by a suitably qualified independent valuer, but for land and buildings, a local council rateable value can be used. However, if you do want to revalue property, plant, and equipment, and you decide to revalue a class of assets, you will have to revalue all of the assets within that class, not just the specific ones you want to revalue. Once you switch to revaluing, you are going to have to continue revaluing those assets going forward. So you won't be able to just switch back to the cost basis. And once you start revaluing, you'll also have to make sure that they're revalued regularly. How frequent this needs to be will depend on the tendency of the value of those assets to change. We have also noted in the exposure draft that if you're using a local council rateable value, that revaluation cycle will usually be sufficient, but you will still have to consider. And as I mentioned, changes in value will be presented as a separate revaluation reserve within accumulated funds. Any gains will be recognized directly in that reserve unless they reverse a previous loss, in which case they'll be recognized through the statement of financial performance. And any losses will be recognized as an expense unless they reverse a previous gain, in which case they'll be recognized through that reserve. So we have really, for losses, are the inverse of the gains. Investment property. This is a new concept in the Tier 3 standard. So we're therefore proposing to define these assets as a class of property, plant, and equipment, which is held primarily by the entity to generate rental income or for capital gains, rather than for use in the entity's ordinary activities. Other than that, in order to keep the standard simple, we are proposing that they are to be accounted for in the same manner as other property, plant, and equipment, which means that you'll have that choice between a cost basis or a revaluation basis. And if they're revalued, the movements will be recognized in a separate revaluation reserve. Finally, we have the proposals for financial investments. What we're proposing is that these will be able to be valued based on their current market price. For example, the NZX quoted price at the balance date. Again, as the intention is to keep the Tier 3 standard simple, we're only proposing that you'll be able to revalue financial investments which are publicly traded, as determining the appropriate value for these investments won't require significant judgment. For example, this includes shares, bonds, and units in managed funds. And for these assets, we're proposing that changes in value are recognized as revenue or expense in the statement of financial performance. We are also proposing that entities will be required to disclose a reconciliation of the movements in the value of their investments, and that will be part of the notes to their performance report, but this will only be required where an entity is choosing to revalue its investments rather than reporting them at cost. So if they're all at cost, you won't have to do that. And after that quick overview, I believe that brings us to the next polling question. Right, so 80% of you agree, which is fantastic for us. to know that we've got that in the right direction. Please do, again, let us know if you are unsure why and what you think we should be doing instead, or what we could clarify. And that brings me to the last significant change for Tier 3, which is our proposals around accumulated funds. We heard from respondents that there should be greater transparency from entities about their approach to managing accumulated funds and any specific reasons that they may be retaining them. In response to this, we're proposing some additional disclosure requirements in the notes to the performance report, which provide information about how the entity is managing its accumulated funds and how it expects to use its accumulated funds to advance its objectives. We have received a few questions about these disclosures. So on this slide is the wording from the exposure draft. Specifically, we're proposing that an entity discloses a brief, high-level description of its general plans for applying its accumulated funds, and also information that enables users of its financial statements to evaluate the entity's objectives, policies, and processes for managing its accumulated funds. Part of the information, or some of the information you might consider disclosing towards this, includes whether there are specific projects that the entity intends to begin in future periods, details of the extent to which accumulated funds are tied up in assets that it uses to carry out purposes, or whether it has any intentions to make a specific future distribution. It's important to highlight, though, that these requirements are really only intended to be a brief high-level description and mention any significant activities in order to provide an overall picture. We aren't expecting entities to disclose any information which would be considered commercially sensitive, or we wouldn't expect it to include a huge amount of detail. We also want to reinforce that nothing an entity reports as part of this is intended to represent some kind of binding commitment or a promise that something specific is going to happen. The objective is just to provide enough information to form an overall impression about what the entity plans to do in general. And I believe that brings us to the last of the Tier 3 polling questions. So I'll just load that up now. I might only leave this open for about 30 seconds or so. Great. So most of you agree with us. So that's fantastic. Thank you very much for that. And now, with roughly 10 minutes to spare, I'll hand back to Carly to very quickly give us the run through of the changes we're proposing to Tier 4.
Thanks, Jamie. So during our post-implementation review, we were told that there are many people struggling to understand and apply the Tier 4 requirements and feel that it is too lengthy and complex for smaller entities. So to address this, we have reconsidered the Tier 4 standard as a whole and simplified the requirements as well as the language. This process has allowed us to cut the standard down to almost half of its original length. We're also proposing plain English and fewer accounting terms, as well as refined categories for reporting cash paid and cash received. We have also developed some reporting exemptions for small Tier 4 entities, and I'll go into this in a bit more detail the next slide. So what do we mean by small Tier 4 entities? So this is one that has total annual payments of less than $10,000 in both the current and previous financial year. These entities will not have to comply with the requirements marked with a red cross here. So this slide sets out an overview of all the sections in the updated standard. So there are quite a few exemptions for these small tier 4 entities, which we hope will help ease their reporting burden. So just to get an idea of what you think about this, we'll go into polling question. And Jamie, if I could ask you to help me again, because it's disappeared. The button.
I might need to take back control.
Oh, right. Right, so that should be appearing on your screens now. So it's very, very high level summary, but be good to see what you think of it. Okay, so that's looking positive. Of course, I encourage you all to read through the standard in detail to see exactly what we propose to exempt. But yeah, that is looking good. Thank you. So the next section I'll be looking at is the service performance reporting requirements. So as we noted for tier 3 entities, we heard that many tier 4 entities were finding the service performance requirements difficult to understand and apply in practice. And as for tier 3 entities, they were finding the terminology used to be quite tricky. So we are amending the tier 4 standard to align more closely with PB FRS 48 as for tier 3 entities, moving away from the outcomes and outputs terminology. So this slide will look quite familiar to you from the tier 3 section. So we have tried to provide a bit more guidance on this topic and simplify the requirements. So in particular, you'll note that we are no longer referring to outputs. Instead, we are just asking an entity to describe what it is aiming to achieve over the medium to long term and describe its significant activities undertaken during the financial year. We have not proposed to include any additional guidance around performance, around appropriate and meaningful measures and or descriptions. Tier 4 entities have much more simplified requirements, and they only need to describe their significant activities and quantify them to the extent practicable. Of course, for the small tier 4 entities, they will not need to quantify anything. So this makes it even easier for them. And as for tier 3, there's no prescribed format that this information needs to sit within. So tables, graphs, that sort of thing, images can be used as well. Right, so that brings me to the next section.
And that's me again. So again, you've seen a good chunk of this before. Most of the problems with the minimum categories were consistent across both of the tier 3 and the tier 4 standard. But there have been a couple of other points that came up when we were talking about tier 4, and often we were told that the term for what it used to be called, where it was the statement of receipts and payments, that word receipts was confusing. So we've moved away from that and we've removed the receipts terminology, for example, and so now it's just the statement of cash receipts and cash paid. Other than that, we're proposing again to increase the number of required categories. We're removing the option to disaggregate. It actually says the statement of financial performance there, but that should be the statement of cash received and cash paid. And we're continuing to allow that additional disaggregation through the notes. So what you'll see on this slide here is the proposed categories of within which you can report cash received. So it is a disaggregation again of the donations or koha from the public into donations, koha, bequests, and other fundraising, and then other grants. For the funding from central local government, we're proposing to split that into general funding from central or local government and funding from service delivery grants or contracts from central or local government. We're not actually proposing to require separation of those other service delivery grants between government and non-government sources for Tier 4. We are continuing on with the commercial activities though, and adding a catch-all for other cash received. And you can, just to reinforce here, also rename the categories. You can provide more detail in the notes. And if a category that's in that list doesn't actually apply to the entity, you can choose not to use that category. And this is the categories of cash paid. So one new one there is fundraising costs, which is really the mirror of the donations, koha, and other fundraising receipts or cash received. Employee-related payments, we're proposing to split that again into employee remuneration and other employee costs. And the payments related to providing goods or services split into costs related to the sale of goods or services and other costs related to the delivery of entity objectives. And like with the cash received, we've got the catch-all for cash paid there. And I would be surprised if the answers to this were all that different, but this is the final polling question about these proposed categories. From memory, that was relatively consistent, but again, it's very nice to always see more than half agreeing with us. So that was fantastic. Thank you for that. And that actually brings us to the end. So I just want to highlight here that you can find the full consultation documents, including the exposure drafts, on our website, along with at a glance summary documents, which provide a higher level overview. Please do submit any comments that you have. Any comments are always welcomed, and you can submit using one of the forms on our website or by emailing us a submission at accounting@xrb.govt.nz. The consultation for this closes on the 30th of September 2022. And these are links to our socials and ways to subscribe to our newsletter. And I believe we had some time here for questions, or it doesn't look like we have any in the Q&A. So if we don't have any questions, maybe I can just give you back 3 minutes of your day. Thank you very much for attending.
Thank you.